Well, we know Tesla is one of the most, if not the most volatile large cap stock that there's ever been in the history of the stock market. And it seems like nobody has the right answer to when to buy or where Tesla stock is going or anything else. Basically, one day everyone is saying buy, next day sell, then go short, then go all in with all your margin and everything, and it's just ridiculous. Unfortunately, it is probably the stock that most falls into the category of I just bought it too high. That is devastating to say the least. So let's talk about the right way to buy Tesla stock. And you can apply this to any stock in the stock market, not just Tesla. It applies to any stock in the stock market there. So even if you aren't interested in Tesla, you can absolutely apply it to any other stock that you're wanting to buy. Just make sure you like the video if you like getting the truth without the hype. Now, I'm actually going to give you two different ways to buy Tesla stock, and you can modify them to your needs. But we're going to talk about two main ones that you can implement today in order to competently buy Tesla stock and to strategically buy Tesla stock to avoid the disasters that we just talked about. So first up is a simple DCA. Now, for those of you guys that don't know, DCA just means dollar cost averaging, and it is by far and away the easiest strategy to implement. But more importantly, it is one of the hardest strategies to actually beat in regards to returns. Actually, in our group, in one of our coaching sessions, our coaches there actually broke out and statistically showed once again how a simple DCA and the second method we'll talk about here in just a second are virtually impossible to beat in regards to return. And probably the biggest reason why it absolutely dominates any other strategy is because it simply removes emotion from the equation altogether. And what I mean by that is think about a time whenever Tesla's running hot, right? Like 2021, hey, it's 300, then it seems like it's 350, then it's 400. I mean, it just can't stop. And then every YouTuber out there is saying it's price targets at 700 and at 800 and at 1500. There were some of those price targets out there in just a year when Tesla was at 400. I'm talking about, I've adjusted down for the split. That's how crazy some of the price targets were out there at that time. And so you're hearing that everywhere. You're seeing it in the comment section everywhere. And you get that FOMO feeling. You fear missing out. Man, I better jump on right now because that Tesla train's going off and I'm going to 4X my money or double up, whatever that case is. And I got to get on it right now. That is pure emotion talking, nothing else. And the same exact thing happened whenever Tesla fell and fell and fell and fell. Lots of people were selling at a loss instead of loading the boat at $100 because you're scared. It's going down. All the YouTubers out there are bearish. All the news articles are bearish. Everybody on CNBC is bearish. Everything out there is telling you bad news, get out. It's going to get worse. Even bullish YouTubers were saying it's going to be 80 and 60. I saw all kinds of crazy price targets out there for Tesla, and it was purely emotionally driven, which means you basically panic sold or sold out of fear, whatever the case was, instead of doing what you should have done, which should have been loading the boat there. That is pure emotion, and that is absolutely what a DCA eliminates. Essentially, to do this, you essentially just put everything on a schedule. So you can do something like every paycheck, I'm going to allocate $200 to go over into my brokerage account, $500, whatever the number is for you. And on that day, once it hits my brokerage account there, the following, Monday, or maybe even that same day, whatever the case is, it doesn't matter. I'm going to buy, X amount of shares of Tesla stock with that money. And you do that week in and week out, or paycheck in, paycheck out, regardless of whether you do it every week, whether you do it monthly, however you choose to lay it out. There is no right or wrong way to do that. It's much more about just consistently buying, regardless of what the price is. So that means, yes, you own some shares at 400, absolutely. But it also means that you were buying shares way down in the 100s as well as it continued to fall. And over the long run, statistically, you beat every other strategy without having to do anything crazy. Statistically, that's what all the studies show. And it's not just a study we did in our group. There are all kinds of studies out there that show DCA beats virtually every other strategy. So now you don't need to worry about, is Tesla on an epic run, or is Tesla crashing and it's going to get worse, or what if Elon tweets this, or what if the short sellers do that, or it doesn't matter at that stage. You're buying the highs, you're buying the lows, you're buying everything in between. And over the long run, you will have an average in the stock that beats the vast majority of investors. And more importantly, you will have a large share count, which is what matters in the end in regards to investing in stocks. No emotions, no crazy charts, no daily logging in to see what's going on, nothing like that. Just put it on a schedule, buy, and forget about it. Now, would I start a DCA into Tesla stock if I was starting at zero and I was a new investor? Well, you can get the answer to exactly that if you join the $250 Legacy Portfolio Challenge for just $15, where I'm essentially starting at zero and just putting in $250 a week, going to DCA into a bunch of different stocks and build out a six-figure plus portfolio. You get to see all those moves in real time, plus you get a library of over 500 educational videos to increase your investing even further. And if you really want to go to the next level, you can become a full member where you not only get access to that, you get access to 5 courses for free, be able to use our stock analyzer tool for free, be a part of the coaching sessions that we talked about earlier, see all my buys and all of my portfolios across all of them, see my complete watch list with price targets, be a part of the best 6, 7, and 8-figure Discord out there with a ton of folks helping you out as well become a better investor. Just check out the pinned comment down there as they're both on sale and get your membership before those prices expire. All right, so the second method is a modified DCA. So how the heck do you do a modified DCA? Well, there's actually multiple ways to do it, but I'm going to give you 2 very specific examples today that our group uses that statistically has proven to even beat a DCA over the long run. So let's talk about both of those next. All right, so the first one, you start out with a basic DCA like we just talked about. But as the stock falls, you actually start to DCA heavier into the stock. So let's say Tesla's fair value is $200, we'll say. Well, just for the example here. So once Tesla gets down below that fair value of $200, you start adding a little bit heavier than you were during your normal DCA, right? Whenever it was going up, you were adding obviously shares. But now that we're getting down below, you're starting to add a little bit heavier. And the further it falls, the little bit heavier you add on that DCA. Not crazy, not all in, not anything else like that. You just start to increase it a little bit more. And the same exact thing works. The way you basically fund that is whenever Tesla goes on runs, instead of doing your normal DCA, let's say again, fair value is 200, Tesla's at $300. Well, you're not going to do your normal DCA amount at that time. You're going to back it down. You're still going to DCA. You're still going to execute the strategy. You're just going to back it down some and not go as heavy as you would have if it was at $200, obviously at fair value. And of course, not nearly as heavy as you would have if it was down at $100, for example. So obviously you continue to lessen it. And obviously when it got to 400, you would lessen that DCA even more and kind of pull all that cash off to the side. So then whenever it falls down the opposite way, now you can add heavier as well on the way down instead. So you're still consistently investing. You're still not trying to time the market. You're just simply using fair value as kind of a buffering point. It's kind of a set point to kind of tell you, do I DCA a little more or a little less? Or do I just it's close enough to fair value to where I just continue right on with my normal DCA? So that right there was the first method, but the second method is a little bit more complex and I would say a little bit more advanced as well. But I will say this, it absolutely kept me from buying at $300 and $400. Absolutely kept me far, far away from that noise. And it had me adding like crazy at, when it was down at 120, 150, 100, all those numbers like that. I was pouring money in like crazy. Now, nowadays, today, this one's pretty easy for me to do. I've been doing this for, almost 25 years now. It's very, very simple. But if you're a newer investor, it's going to be a little bit harder and you're going to make mistakes. But the key is that is okay in the end. I did not start, when I started using this strategy, I was not perfect with it at all. As a matter of fact, I was off my very first time doing it by like 40% or so. That's how poor I did at this. But the good news is when you're investing in great stocks over the long run, they take care of you regardless. Great stocks make up for a lot of your mistakes in the end. Now I'm talking about over the long run. Short run, of course, I was down 40%, right? I lost in the short term per se, lost. But over the long run, it took care of everything else for me, so I didn't have to worry about it. So it's not easy. It takes some practice. You're going to make some mistakes. That's okay. This is what I teach in the group specifically there. Obviously, we have different coaches teaching different things. It's the one that I teach there in the group. And so it's worked out for me really well for a long time. So let's talk about the specifics of it next. So the first thing you have to do is you have to do evaluation and understand what a fair price or fair value is for stock, in this case, Tesla specifically. You have to do that. That is why I preach it so much on this channel, because if you understand where fair value actually is for the stock, not hype projections, not crazy bear points that make absolutely no sense either. If you understand legitimately what fair value is for the stock, it makes investing so much easier. Even if you don't want to use these methods, even if you want to do a third method or fourth method, even if you want to trade it at some point in time, understanding valuation can make you far more successful and makes a lot of those strategies far more successful than not understanding it all. So it all starts right there with valuation, understanding where fair value is. And then next up would be setting a price target. And to keep this example simple and to not get too complex, just go ahead and set your first price target right there at fair value. Now, here comes the hard part right here. You have to be patient because the stock may be above what fair value actually is. Think about just the past time we just had, 2021, beginning of 2022. Hey, fair value was $200, for example, and the stock was trading at 300. It means that you're doing nothing right now, despite the fact that it ran all the way up to 400. It still meant you did nothing. You waited until the stock got down to fair value. As the stock falls and it starts getting closer to fair value or whatever your price target was, That right there is when you start executing a simple DCA, and you continue to DCA heavier as it falls down until you basically fill out your entire position if it falls that far. Obviously, a lot of times the stock can, get down, I'm adding, and then all of a sudden it goes on a rocket ship back up, maybe add one more time on the way up, and then it gets above fair value again. I got to take a break, got to take a little bit of a breather there, and then continue to build out my positions as I go, going back and forth. Again, it's harder, requires a lot more patience. It requires you getting rid of all the noise that's out there, get it basically out of your calculus at all, but it's absolutely effective and not overpaying for the stock. You may build out your entire position at fair value. That's okay. You don't have to have a full, you don't have to own all your shares in Tesla stock at $50 or all your shares in Palantir at $7. We just got that last year or whatever the case was. You don't have to. Over the long run, that's going to be far less important than share count. So just make sure you're filling out your positions and buying whenever it gets to that fair value or it gets down below fair value. Now, here's kind of the next step in that. Great companies, I always want to continue to add shares because I know share count matters. But now I use the same exact modified DCA strategy. Just I take my price target, I find fair value, and then I put it down below because I want a discount, right? I have all the shares that I need. I don't need any more shares. I don't necessarily want any more shares. But Wall Street gets dumb all the time, and I will happily add shares to any great stock if they get beaten down. I'll use the Meta example because I thought I would never add to my Meta position again. I had a very nice Meta position from a long time ago. No need to add any more. Meta had been trading rich for a really, really long time, so there was no need. Amazon, same exact situation. Amazon's traded rich for a really, really long time. And then for some reason in 2022, all of a sudden, Meta's a dead company. Amazon's a dead company. Google's a dead company. I don't know, there's some of the best companies in the world, but yet that was the narrative that was out there. Wall Street got dumb, and I got to implement this exact strategy and just basically pour every dollar I could into those stocks as they were continuing to fall because, hey, you're not getting these sorts of deals every once in a while. In some cases, it had been years since I had bought those stocks, but that patience paid off, and I was able to build out larger positions and buy a lot more shares than I ever thought I was ever going to have because I simply had price targets in the first place. I understood fair value. And whenever great companies get down below that fair value and then stupidly below fair value, it becomes very easy to continue to pull the trigger and add shares. All I did was set price targets and buy shares. And then if it wanted to fall lower, I would buy more shares, kind of rinse and repeat. Now, the problem with this strategy is hype runs make it much, much harder to do, especially when people are making money. I was just getting screamed at in the comment section, even in my group. There were a lot of folks that left the group because it's like, why aren't you buying Tesla at 400? Why not? Everybody else is, and everybody else that bought it, 350, and look at how much they're up in just a few weeks, and all kinds of things like that. And then some folks would get really mad when I said, yeah, it's overvalued and it's coming down. And I knew that. And it wasn't rocket science, guys. It wasn't anything special. Just simply did a valuation. And the valuation told me a multiple 1,000 for Tesla stock or any stock is utterly ridiculous. The price is going down or it's going to trade flat for years. And both of those things happened. Now, I did not know it was going all the way down to 100. That was not on my bingo card. I had no freaking clue about that. But I also knew 400 was not a price I was willing to pay anytime soon for Tesla stock. Maybe, 5 years, 8 years into the future, if they prove it with revenue and EPS and everything else, maybe so. But for that time frame, it was not worth anywhere near that. And it couldn't have been worth anywhere near that, even if I gave it a 50% growth rate because of valuation. I have used every single one of the methods we discussed today, and every single one of them works. So if a modified DCA, the way I do it, seems a little bit confusing, great. Use one of the other ones. Use the other modified DCA or do a simple DCA. They all work in the end, and don't make this complicated. And more importantly, guys, don't fall for all the hedge fund BS out there and buy this and sell that and short this and then go all in with margin on that and back and forth and rinse and repeat and all the craziness like that. Do not get confused by all that noise. Just implement and use one of these 3 different methods right here that we talked about today, and you will do better than all the traders and all the folks out there playing games, because here is another fact for you guys. Dead people return better than traders. That is factual as well. Dead people actually beat traders. So there's no point in even following those guys or listening to anything that they say. Just keep it simple in the end. And if you want to learn how to do valuations, if you want to learn how to do a modified DCA, see myself execute a modified DCA, or see all of our group members who are executing all different strategies and they post all their buys in real time. Obviously, we got a $250 portfolio challenge going on Folks are posting all their buys in there constantly and their portfolio updates and everything else. Make sure you check out the pinned comment down there and see which membership is right for you, where you get all that. You can also get access to free coaching, 5 courses, the best 6, 7, and 8-figure Discord out there, helping you guys become better investors, helping me become a better investor in a lot of different ways. And there's so much more, guys. Check out the pinned comment before the sale expires and the prices all go back up. And click this video here if you want to see exactly what I'm buying in this market. And click here to see my exact plan for this market. So thanks for watching, and we'll see you in the next one.